Before you invest a single dollar in 2026, before you chase the next hot stock, crypto trend, AI headline, or social media tip, you need to hear this, because the biggest risk to your money in 2026 won't be inflation, it won't be interest rates, it won't even be market crashes. The biggest risk will be how you think. Charlie Munger, one of the greatest investors who ever lived, used to say that investing isn't about being smart, it's about not being stupid. Before you invest a single dollar in 2026, you need to understand one truth that most people ignore: your mindset will matter more than any market prediction, expert forecast, or breaking news headline. The world is entering a time where information is endless, instant, and overwhelming. Prices will move in seconds, opinions will spread in minutes, confidence will be loud, persuasive, and often wrong. In this environment, the real danger isn't not knowing enough. It's reacting too quickly to what you think you know. Most investors believe success comes from finding the right stock, the perfect entry point, or the next big trend. But history shows something very different. Markets don't punish ignorance as harshly as they punish emotional behavior. Fear causes people to sell at the bottom. Greed convinces them to buy at the top. Envy pushes them into investments they don't understand simply because someone else is making money. None of these mistakes come from lack of intelligence. They come from lack of emotional control. In 2026, predictions will be everywhere. Some will sound convincing. Many will be backed by data, charts, and confident language. But no one truly knows what the market will do next. The investors who survive and succeed are not the ones who predict the future accurately, but the ones who remain rational when uncertainty dominates. They understand that uncertainty is not a flaw in the market, it is the market. A strong mindset means being comfortable with not acting. It means understanding that doing nothing is often a decision, and sometimes the best one. When prices fall sharply, the mind searches for safety. When prices rise rapidly, the mind searches for excitement. Both impulses are natural, but neither should control your actions. The disciplined investor learns to pause, think, and ask better questions instead of reacting to feelings. Your mindset also determines how you interpret losses. A short-term loss doesn't automatically mean you were wrong. Likewise, a short-term gain doesn't mean you were right. Without the right mental framework, investors chase validation instead of truth. They look for confirmation, not understanding. Over time, this behavior compounds into poor decisions that no strategy can fix. The market is not a test of intelligence. It is a test of temperament. Some of the smartest people in the world lose money because they cannot manage their emotions. Meanwhile, calm, patient thinkers with average intelligence often outperform simply because they remain consistent and rational over long periods of time. They know their limits. They respect risk. They don't confuse confidence with certainty. As 2026 approaches, the most important investment you can make is not in a stock, a fund, or a trend. It is in how you think under pressure. Build habits that slow you down. Question your assumptions. Learn to recognize when emotion is driving your decisions instead of logic. The market will always tempt you to act quickly, but success belongs to those who think clearly when others cannot. In the end, markets reward discipline, patience, and self-awareness far more than predictions. If you master your mindset, you won't need to guess the future. You'll be prepared for it. One of the most misunderstood truths about investing is that success does not come from making brilliant decisions all the time. It comes from avoiding the few decisions that can permanently damage you. In 2026, the market will offer countless opportunities, but it will also present countless traps. The difference between long-term success and long-term regret will not be how many winning investments you make, but how well you avoid the obvious, costly mistakes. Most people approach investing as if it were a game of offense, constantly searching for the next big winner. They believe wealth is built by bold moves, aggressive bets, and perfectly timed decisions. But history tells a different story. The greatest investors didn't win because they were always right. They won because they were rarely wrong in ways that mattered. They avoided leverage they didn't need. They avoided businesses they didn't understand. And most importantly, they avoided overpaying, even when everyone else was convinced the price would keep going higher. In 2026, hype will be one of the most dangerous forces in the market. When an asset is rising quickly, logic is often replaced by stories. People stop asking whether something is worth its price and start asking how much higher it can go. This is how bubbles are formed, not by bad assets, but by good assets bought at irrational prices. Overpaying is one of the easiest mistakes to make and one of the hardest to recover from. Even a great business can become a terrible investment if the price is too high. Another common mistake is complexity. Investors often assume that complicated strategies produce better results. They chase derivatives, leverage, and highly technical systems without fully understanding the risks involved. Complexity gives the illusion of sophistication, but it often hides danger. When things go wrong, and eventually they do, those risks surface all at once. Avoiding what you don't understand is not a sign of weakness, it is a sign of wisdom. Emotional mistakes are just as destructive. Panic selling during market downturns locks in losses that were never permanent. Chasing fast-rising assets out of fear of missing out often leads to buying at the worst possible time. These behaviors feel justified in the moment, but they quietly erode long-term results. Avoiding these mistakes requires humility, the ability to admit that you don't need to participate in every opportunity to succeed. Risk, when misunderstood, is another silent killer. Many investors think risk means volatility, but real risk is the chance of permanent loss. A portfolio that swings up and down may be uncomfortable, but a portfolio built on weak foundations can collapse entirely. Avoiding businesses with fragile balance sheets, unreliable cash flow, or unclear economics is far more important than chasing short-term stability. Wealth compounds when you stay in the game long enough. Big mistakes remove you from the game. A single reckless decision can undo years of disciplined progress. That is why avoiding errors matters more than finding home runs. You don't need extraordinary insight. You need consistent judgment and the patience to wait for opportunities that make sense. In 2026, the investor who wins will not be the one who takes the biggest risks, but the one who avoids the unnecessary ones. By focusing on preservation first and growth second, you give yourself the most powerful advantage of all, time. In a world that rewards speed, patience has quietly become one of the most powerful advantages an investor can have. By 2026, markets will move faster than ever. Trades will happen in milliseconds. News will spread instantly, and opinions will form before facts are fully understood. In this environment, constant action will feel productive, even responsible. But the truth is, activity and progress are not the same thing. Often, the more you do, the more you get in your own way. Many investors believe that being active means being smart. They monitor prices constantly, react to every headline, and feel uneasy when they are not doing something. This mindset creates the illusion of control, but it usually leads to overtrading, higher costs, and worse decisions. Every transaction carries friction, fees, taxes, and the risk of poor timing. Over time, these small disadvantages compound, quietly eating away at returns. Patience is not about passivity, it is about selectivity. The most successful investors wait for situations where the odds are clearly in their favor. They understand that truly great opportunities are rare, and forcing decisions in mediocre conditions often leads to mediocre results. Saying no is just as important as saying yes. In fact, most of investing success comes from knowing when not to act. In 2026, the pressure to act will be relentless. Social media will highlight overnight success stories. Financial news will create urgency with every market move. The fear of missing out will convince many people that waiting is a mistake. But patience protects you from this noise. It allows you to step back, evaluate opportunities calmly, and avoid being pulled into decisions driven by excitement or fear. Waiting also gives you clarity. Time reveals information that speed cannot. A business that looks promising in the short term may reveal weaknesses over a longer period. A market trend that seems unstoppable may lose momentum once emotions fade. Patience allows reality to catch up with perception. It gives you the ability to observe rather than react. Another overlooked benefit of patience is emotional stability. Constant trading creates constant stress. Every price movement feels personal. Wins create overconfidence and losses create anxiety. Over time, this emotional roller coaster clouds judgment. Patient investors experience fewer emotional swings because they are not tied to every short-term fluctuation. They focus on long-term value rather than daily price changes. Some of the greatest investment results in history came not from frequent decisions, but from long periods of inactivity followed by decisive action. These investors waited, sometimes for years, until conditions aligned. When they finally acted, they did so with conviction because they had done the thinking beforehand. Their success was not the result of speed, but of preparation. Patience also works in your favor through compounding. Time is the engine that turns small, reasonable returns into meaningful wealth. Every unnecessary trade interrupts that process. Every emotional decision resets it. By staying invested in sound opportunities and resisting the urge to constantly adjust, you allow compounding to do the heavy lifting. In 2026, when everything pushes you to move faster, patience will help you slow down. It will protect you from overconfidence, reduce costly mistakes, and keep you focused on what truly matters. In the long run, the investor who waits wisely will outperform the one who is always in motion. Before putting your money into any investment in 2026, there is one rule that should never be ignored. If you do not understand how something makes money, you should not invest in it. This principle sounds simple, yet it is violated every day by intelligent people who confuse familiarity with understanding. Hearing a company's name often, seeing its stock price rise, or watching others profit from it does not mean you understand its business. True understanding goes much deeper. Understanding a business means being able to explain in plain language how it earns revenue, what costs it incurs, and why customers choose it over competitors. If you cannot describe these basics without jargon or buzzwords, then your investment is built on hope rather than knowledge. Hope is not a strategy. In fast-moving markets, it becomes a liability. In 2026, complexity will be one of the biggest traps for investors. Many businesses will operate in advanced technologies, financial structures, or emerging industries that sound impressive but are difficult to evaluate. Complexity often hides risk. When you don't understand a business, you cannot accurately assess what could go wrong. You don't know what variables truly matter, which assumptions are fragile, or how the company might perform under stress. Investing without understanding also removes your ability to stay calm during volatility. When prices fall, confidence is tested. If you know the business well, price fluctuations are easier to endure because you can separate temporary market emotion from long-term value. But if you never understood the business in the first place, a falling price creates fear. Fear leads to panic selling, often at the worst possible time. Another danger of not understanding a business is relying too heavily on others. Analysts, influencers, and headlines can provide useful information, but they cannot replace your own judgment. When you outsource understanding, you also outsource responsibility. If the investment fails, you are left confused, wondering what went wrong. Understanding gives you ownership of your decisions and accountability for the outcomes. Knowing how a business makes money also helps you recognize when something changes. Businesses evolve, and not always for the better. New competitors, regulatory shifts, or changes in customer behavior can weaken once strong models. If you understand the core economics, you can spot warning signs early. Without that understanding, problems often go unnoticed until the damage is already done. Understanding does not require predicting the future. It requires knowing the present clearly. You don't need to know exactly what will happen in 5 years, but you should know what needs to stay true for the business to succeed. If those conditions seem fragile or dependent on perfect execution, the risk may be higher than it appears. Some of the best investments are boring. Simple businesses with predictable cash flows often outperform exciting stories over time. Understanding allows you to appreciate simplicity in a world that constantly sells excitement. It helps you resist the urge to invest in what sounds impressive and instead focus on what actually works. In 2026, opportunities will be abundant, but understanding will be rare. The investor who takes the time to truly understand a business gains clarity, confidence, and resilience. And in investing, those qualities are far more valuable than chasing what you don't fully grasp. Markets may appear to move on numbers, charts, and data, but beneath the surface, they are driven by human behavior. Prices rise and fall, not just because of earnings or interest rates, but because of fear, greed, hope, and social pressure. In 2026, understanding psychology will be more important than understanding spreadsheets, because the speed of information will amplify emotional reactions across the market. Fear is one of the strongest forces shaping market behavior. When uncertainty increases, people instinctively seek safety. Bad news spreads faster than good news, and negative headlines trigger panic far more easily than calm analysis. In these moments, prices often fall faster than fundamentals change. Investors sell not because value is gone, but because fear demands immediate action. Those who don't recognize this psychological pattern often mistake emotional reactions for rational signals. Greed operates just as powerfully, especially during rising markets. When prices climb steadily, caution feels unnecessary. People begin to believe that the rules no longer apply, that this time is different. Stories replace analysis, and confidence grows without a matching increase in understanding. As more people participate, prices detach from reality. Greed doesn't announce itself as recklessness, it disguises itself as optimism and certainty. Social pressure adds another layer to these emotional forces. Humans are wired to follow the crowd, especially in uncertain environments. In investing, this creates herd behavior. When everyone around you is making money, standing aside feels uncomfortable. The fear of missing out becomes stronger than the fear of losing money. This pressure pushes people into investments they would normally avoid, often at the worst possible time. Cognitive biases quietly influence decisions as well. Confirmation bias leads investors to seek information that supports their existing beliefs while ignoring warning signs. Recency bias causes people to assume that recent trends will continue indefinitely. Overconfidence convinces them they understand more than they do. These biases don't disappear with experience or intelligence, they affect everyone. The difference is whether you acknowledge them or let them control you. In 2026, technology and media will intensify these psychological effects. Algorithms will highlight extreme opinions because they attract attention. Short-term performance will be constantly displayed and compared. This environment encourages emotional decision-making, even among disciplined investors. Recognizing that the market is often a reflection of collective emotion rather than pure logic helps you step back and regain perspective. Understanding market psychology doesn't mean trying to exploit others' emotions. It means protecting yourself from your own. When you recognize fear, greed, and social pressure at work, you can pause instead of reacting. You can ask whether a decision is driven by fundamentals or feelings. This pause creates space for better judgment. The most successful investors are not emotionless, they are self-aware. They accept that emotions will arise, but they don't let those emotions dictate their actions. They build rules, habits, and frameworks that guide decisions during emotionally charged moments. This discipline allows them to act rationally when others cannot. Markets will never be perfectly logical because humans are not perfectly logical. In 2026, this reality will be even more pronounced. The investor who understands the psychological forces behind price movements gains a powerful advantage, the ability to stay calm, think clearly, and make decisions based on reason rather than reaction. In investing, excitement is often mistaken for opportunity. Fast gains, dramatic stories, and bold predictions capture attention and create the feeling that something important is happening. Discipline, on the other hand, is quiet. It is repetitive, sometimes boring, and rarely celebrated. Yet over time, discipline is what builds real wealth. As 2026 approaches, the gap between short-term excitement and long-term success will become even wider. Short-term thinking thrives on immediacy. It focuses on what is happening now, what is trending today, and what might surge tomorrow. This mindset is constantly pulled by headlines and price movements. Every fluctuation feels meaningful, every dip feels dangerous, every rally feels urgent. Acting on these impulses may feel productive, but it often leads to decisions that prioritize emotion over logic. Long-term discipline works differently. It begins with a clear framework for decision-making and a commitment to follow it consistently. Instead of reacting to daily noise, disciplined investors focus on fundamental value, long-term trends, and sustainable growth. They understand that progress is uneven and that temporary setbacks are part of the process, not signs of failure. One of the greatest challenges to long-term discipline is boredom. When markets are calm or moving slowly, impatience sets in. Investors feel the urge to do something just to feel involved. This is where many mistakes are made. Unnecessary trades, speculative bets, and strategy changes often come from discomfort with inactivity rather than genuine opportunity. Discipline requires the ability to sit still while others chase excitement. Another challenge is comparison. In a connected world, you are constantly exposed to others' successes. Someone is always making more money faster, often with risk you cannot see. This creates pressure to abandon long-term plans in favor of short-term gains. Discipline means accepting that your path will look different, and that slower, steadier progress is not a weakness. Long-term discipline also protects against overconfidence. Short-term success can create the illusion of skill, leading to bigger risks and looser standards. Disciplined investors treat success cautiously, understanding that markets can be generous for reasons unrelated to ability. They stick to their rules even when things are going well, knowing that consistency matters more than momentary wins. Time is the most powerful force in investing, but it only works for those who remain committed. Compounding rewards patience, not excitement. Small, reasonable returns, sustained over many years, outperform dramatic gains that cannot be repeated. Every time you abandon discipline for excitement, you interrupt that process. In 2026, markets will offer endless distractions. New technologies, bold narratives, and sudden opportunities will demand attention. Discipline will help you filter out what doesn't matter and focus on what does. It will guide you to make decisions based on reason, not reaction. In the end, wealth is not built in moments of excitement. It is built through years of consistency, restraint, and clear thinking. Long-term discipline may not feel thrilling, but it is the most reliable path to lasting success.